You've been told a simple story about money, that banks take deposits, that loans are made responsibly, risk is priced, measured, and contained. But what if the real system holding the global economy together isn't money at all? What if it's collateral quietly reused, rehypothecated, pledged, repledged, sliced, bundled, and promised again and again, until no one can tell who actually owns what? Tonight's question is unsettling but unavoidable. What is the Global Collateral Network? And why does every major financial crisis trace back to it? The mystery isn't that debt exists. The mystery is what stands behind it. And the answer lives in a shadow system most people never see, yet everyone depends on. To understand the system, we need to start with something older than modern banking itself: trust. For centuries, lending required something solid: land, gold, grain, ships. Collateral was tangible. If the borrower failed, the lender took possession. Simple cause and effect. But as economies expanded, finance needed to move faster than physical assets allowed. Gold couldn't teleport across borders. Land couldn't be divided instantly, so the system evolved. In the late 19th and early 20th centuries, government bonds emerged as the ultimate collateral, as they were standardized, trusted, liquid, and most importantly accepted everywhere. The bond wasn't just a promise of future payment. It became a tool. You could pledge it to borrow, then pledge the borrowed funds again, and then pledge those obligations once more. Collateral stopped being the end of a transaction, became the beginning of a chain. This was the quiet birth of the Global Collateral Network. The real acceleration came after World War II. Governments needed massive funding, banks needed liquidity, central banks needed control. The Bretton Woods system stabilized currencies, but beneath the surface, bonds became the backbone of interbank lending. Then came the 1970s. When the gold standard ended, money lost its physical anchor. But the system didn't collapse because something else took gold's place. High-quality collateral, U.S. treasuries, German bunds, UK gilts, later mortgage-backed securities. These instruments became the new money behind the money. Repurchase agreements, repos, exploded. In a repo, one institution lends cash. Another provides collateral with a promise to reverse the transaction later. On paper, it's short-term and safe. Reality, it allowed the same collateral to circulate endlessly through the system. One bond could support multiple loans. One asset could back layers of leverage. This wasn't illegal, it wasn't even hidden, but it was underestimated. The Global Collateral Network was no longer a safety mechanism, it was the engine. As financial markets globalized in the 1980s and 1990s, the network stretched across borders. London became the center of collateral velocity. New York became the center of collateral creation. Europe and Asia became dependent nodes. Banks didn't just hold assets anymore. They optimized them, lending them out, borrowing against them, rehypothecating them to maximize returns. Shadow banking institutions, money market funds, hedge funds, structured investment vehicles joined the chain. Risk didn't disappear, it moved. By the early 2000s, the system relied heavily on mortgage-backed securities as collateral. Home loans, often poorly underwritten, were transformed into AAA-rated instruments and injected directly into the collateral bloodstream. The cause and effect was clear, but ignored. More collateral meant more leverage. More leverage meant more profit. More profit meant more incentive to ignore fragility. And then came the breaking point. In 2008, the Global Collateral Network didn't fail gradually. Froze. When housing prices fell, mortgage-backed securities lost credibility. Suddenly, institutions didn't trust the collateral they were holding or the counterparties they were lending to. Repo markets seized up. Haircuts increased overnight. Collateral chains snapped. Banks weren't insolvent because they lacked money. They were insolvent because their collateral stopped working. The shadow system became visible for the first time right as it stopped functioning. Central banks stepped in, not just to provide liquidity, but to replace collateral itself. They expanded balance sheets, accepted weaker assets, and injected confidence by force. The crisis wasn't solved, it was deferred. The fallout reshaped the system, but not in the way most people think. Regulations increased, capital requirements rose, stress tests became routine. But the global economy still needed leverage to grow, so the collateral network adapted. Government debt expanded massively. Central banks became the largest holders of high-quality collateral. Quantitative easing removes safe assets from the private market, creating a collateral shortage. And shortages create distortions. To compensate, institutions reused collateral even more aggressively. Synthetic collateral multiplied. Derivatives replaced physical assets. The system became cleaner on paper and more fragile in reality. The fix didn't eliminate the problem, it concentrated it. Fast forward to today, trillions of dollars in global finance depend on collateral chains that span continents and time zones. A single treasury bond might support loans in New York, derivatives in London, and margin requirements in Ashwell within the same day. The system works until it doesn't. We've seen warning shots. The European sovereign debt crisis, the 2019 repo market spike, the 2020 liquidity dash during the pandemic, the collapse of leveraged funds when collateral values swing too fast. Each time, the pattern repeats. Collateral confidence breaks, liquidity evaporates, central banks intervene. The lesson is consistent and, rarely stated plainly, modern finance is not built on money. It's built on trust and collateral velocity. This isn't just abstract finance. It affects everyday life. Pensions rely on collateralized markets. Mortgages depend on securitization. Government spending assumes uninterrupted bond liquidity. When collateral chains strain, interest rates rise, credit tightens, and economies slow long before headlines catch up. The shadow system binds all debt together. When one link weakens, stress travels invisibly through the entire network. So what are we meant to learn from this? First takeaway. Debt is no longer limited by borrowers. It's limited by collateral quality. When safe assets are questioned, the entire system reacts. Second takeaway. Crises don't start with defaults. They start with doubt. The moment institutions question collateral value, leverage collapses faster than regulation can respond. Third takeaway. Every fix so far has increased dependence on the same system. More central bank support, more government debt, more reliance on collateral confidence. The open question is uncomfortable, but necessary. What happens when the world runs out of unquestioned collateral? Not when debt becomes too large, but when trust becomes too thin. Because once confidence breaks at the foundation, no amount of liquidity can rebuild it overnight. If you want to understand future financial shocks, don't just watch interest rates or inflation numbers. Watch collateral. Watch repo markets. Watch what assets everyone assumes are risk-free. That's where the real story begins. If this video changed how you see money, debt, or financial stability, let me know by liking and sharing it. Subscribe if you want more deep dives into the systems that quietly shape your life, and leave a comment with the question you think no one in finance wants answered, because the most powerful forces are rarely the loudest, the ones hiding in plain sight.